Welcome folks, how are you all? I hope everyone is cool. So yesterday I have cleared about the order block theory and that's all my opinion. Thanks not for making any controversy. Yeah, in this video I would love to make clear about the mitigation block. Now everything here is my experience, the way I look for the mitigation block. So if you would love to take this, you have to do the back test. If you get the precision, you can follow this, otherwise just let it go, okay? Just skip this video. I don't really want any kind of controversy. So this video, if you watch until the end, you will understand how to look for the mitigation block. The first thing is, I'm just gonna take this small price action and I would love to show you the mitigation block from here. The first rule is you have to look for the liquidity. For example, you have this sell side liquidity. So you were thinking that market is going to take that sell side liquidity. By anyhow, you knew your bias was bearish and you saw this relatively equal loss and that is your target. Okay, you saw market is going higher. This is the highest high. Okay, market went higher, it has cleared all of this liquidity, so this is the long term high. First you have to find out a long term high. Then market went higher one more time but failed to take that high. Look over here, it has just failed to take that high. Yeah, you can say that. Let me show you. High, low, lower high. So this low is your mitigation block. No, I am not looking for the mitigation block to the first this type of situation. No, I am not looking for being a mitigation block. I need something else. When this high happened, market failed to take that high, but there is no other high left. Okay, so this high failed to take the long term high. Then market went lower, tried one more time to take that high. Now I will look for the mitigation block. So high, low, lower high. Between two high, the lowest down close candle is my mitigation block. So this will be my mitigation block and I'm gonna mark it as I'm gonna write it down, mitigation block. Okay, so MITIGATI. So that's my mitigation block. Now is it enough? I mean, is it done? No, it's not done actually. When I saw high, low, lower high, the first thing is market has to close below that block. You see, this time this candle has closed below that mitigation block. Then it actually eligible for being a mitigation block. This candle closed below that mitigation block. The very next candle trade that. I have to be in the market already. Okay, so over here, that will be your entry. Where will be your stop loss? Just above the mitigation block. Now, if you are over conservative, you can put it above that swing high. It's up to you, the way you actually you manage your trade. Okay, and this relatively equal loss, that will be your target. So that will be your trade. Okay, you can see market went one more time higher, trade that mitigation block, then fall. Is it done? No, it's not done. When I saw this is the long time high which has cleared all of the buy side liquidity. Okay, it made relatively equal lows, made relatively equal highs. Market has taken relatively equal highs or every kind of buy side liquidity, went lower, then tried to go higher one more time, failed to go high and failed to take the all long time high. Okay, this in this small price action, this is the long time high. Market failed to take that long term high. Then I will start to look for either breaker block or mitigation block. If I see market went lower, went higher, but not that high, so it's gonna be on my mitigation block. If it went higher, then you can mark that as a breaker block. I mean, breaker block, that is different matter. I don't want to talk about the breaker block in this video. But over here, if this high, now if this high failed to take that high, then I will look for mitigation block. I need to go to E-mini S&P now. Now E-mini S&P is very important for me. I don't like Dow. I love E-mini S&P. Okay. Now over here I will look how the E-mini S&P worked. You can see this is that all-time high. I mean, sorry, long-time high. Okay, this high and this high, they are the same high, long-time high. Okay, and over here the long-time high has been taken over here. Okay, so this high, see, this high failed to take that high, but here the liquidity has taken one more time. Now what I'm seeing here, I'm seeing just opposite to E-mini S&P. Over here there is the same liquidity over here. Okay, so this is the same liquidity You can see not the same low. I mean this low and that low, no, not the same low, but still I have the relatively equal lows in E-mini S&P as well. So in E-mini S&P has to have the liquidity as well. I mean this type of clean liquidity it has to have over there. If there is no clean liquidity, then this setup is not perfect. Okay, you are not looking for this if there is not the liquidity for both of the market. The first rule is both of the market has to have the liquidity. I can see relatively equal lows here, relatively equal lows here. Okay, so we have sell side liquidity from both of this market. We know market is going to that sell side liquidity. Now E-mini S&P, what it has done, it has made all, I mean the long high. Same Nasdaq has made the long high, taken all the liquidity. Market went lower, market went lower. It has taken that long high one time, but here Nasdaq failed to take that long high. So I got the SMT here first. So this is called SMT here. I get the SMT. Now I am looking for mitigation block. Here I got lower high. See, again lower high. But what I get here, another SMT, higher high. That means market has taken that high as well. This SMT is going to make that mitigation eligible. Is it clear, guys? In short, first of all, you have to find out your liquidity in both of the market. You can see I have this clean sell side liquidity, clean sell side liquidity. In Nasdaq, I know market is going to take that sell side liquidity. In E-mini S&P, I know market is going to take that sell side liquidity. Okay, market went higher, make the long time high. In E-mini S&P also, market went higher before taking that sell side liquidity. It went higher, make the long time high. It went lower, try to take that long time high one more time, but fail here. But in E-mini S&P, it has taken that long time high. Okay, I got SMT. So this is my SMT. Let me say, yeah, sorry, that is my SMT. Okay, I got my SMT here. That is SMT. Okay, not that one. Sorry, this one should be the SMT. The first one here and here. When I got the SMT, am I going to take sell? No, I'm not going to take sell. Now I will look for the mitigation block. Can market make another lower high with a swing low? This swing low has to be very clean. So low, high, low, lower high, high, low, higher high. This SMT, the next SMT, okay, this one, valid that mitigation block for taking entry. Okay, guys. In short, this is the way you will take the entry to that mitigation block, market will go lower. So I believe that it's little clear to understand when you will look for SMT and how you actually manage this mitigation block. This is the way. I try to make it clear, and you have to observe the both of the market at the same time. If you can do it like this way, I believe that most of the time you will get the precision and you will understand how to use the mitigation block. If you like this video, don't forget to give me a thumbs up, and if it helps you, then and you are new, you can subscribe to my channel. Okay, I'm gonna put the link of my order block at the beginning of this video, sorry, at the end screen, so you can watch that one as well. So until the next video, cheers.